Okay, let's dive right into this and uncover the massive tectonic shift happening literally right beneath our feet in the digital asset world. Welcome to This Explainer. Now, today, we're not going to be talking about the daily ups and downs of token prices. Nah, we're unpacking a fundamental rotation of wealth and infrastructure that Wall Street is whispering about right now, but only the most observant folks are actively mapping it out. We are actually witnessing the birth of the crypto AI hybrid, and let me tell you, it's completely rewriting the rules of what gives a digital company its real value. It sounds completely counterintuitive, right? Like, what if a crypto company's absolutely most valuable asset is no longer its crypto? For a decade, we've basically all just stared at screens, tallying up digital holdings, scrutinizing mining incomes, and watching those trading volumes. But while everyone was hyper-focused on those flickering tokens, institutional money, well, they started looking at something else entirely. They started aggressively buying up physical sovereignty and heavy infrastructure. Because in this modern era of computing, the market has quietly decided that raw power, physical land, and data center access, yeah, they matter a whole lot more than what's sitting in your token treasury. So we are experiencing this fundamental rotation from what we call the old VAS blends, that stands for virtual asset service providers, by the way, to this entirely new AI infrastructure lens. In the old world, your value was completely tied to volatile trading volumes, fluctuating token prices, and mining profits that just swing wildly depending on network difficulty. Basically, it monetizes volatility. But the new AI infrastructure lens, it monetizes scarcity. It is built on actual physical power capacity and these multi-year locked-in hyperscaler leases. For an institutional investor, that translates to predictable utility-style cash flows. And make no mistake, Wall Street will absolutely always pay a higher premium for a business they can accurately model rather than one just built on unpredictable market sentiment. To really see this playing out in the real world, we have to look at Galaxy Digital and their Helios campus down in Dickens County, Texas. So back in 2022, Galaxy acquired this massive site, and pretty much everyone thought, oh, it's just a play for cheap electricity to mine Bitcoin. But actually, scratch that. They were looking 2 or 3 steps ahead. They started aggressively transforming the site into a literal fortress for high-performance computing and AI data infrastructure. And here's why this is a real game changer. In June 2026, Galaxy stock surged sharply. It caught a lot of traditional crypto investors totally off guard because they were out there looking for Bitcoin ETF flows or retail volume to explain the bump. But the smart money, they weren't buying Galaxy for its tokens. They were reacting to massive strategic infrastructure deals, like their partnerships with the AI cloud giant CoreWeave. They were buying the physical infrastructure. Moving on to Section 1. Energy bottleneck, the AI power grab. Now, if you think this pivot to AI infrastructure is just some temporary hype cycle, the hard data from Goldman Sachs Commodities Research is going to change your mind for sure. U.S. data center power demand is sitting at about 31 gigawatts in 2025. By 2026, it jumps to 41 gigawatts. And by 2027, it absolutely skyrockets to a staggering 66 gigawatts. It is on track to more than double in literally just 2 years. So this isn't just a simple expansion, it is a structural power grab. The biggest challenge for AI right now isn't actually building smarter models. It's securing the sheer amount of electricity required to just train and run them. To put that insane growth into perspective, let's talk about what it means for our actual electrical grid. Data centers are actively devouring a massive share of the grid's total capacity. In 2025, they account for about 4.1% of total U.S. peak summer power demand. But by 2027, that leaps to 8.5%. Think about that. Power access is no longer just some minor footnote on a utility bill. It's becoming a premium asset class all on its own. The firms that already hold the keys to these energy-rich sites, they are quickly becoming the ultimate gatekeepers to our entire next-generation compute economy. But here is the brutal execution reality, 50 to 60%. Look, building a data center isn't like just flipping a switch. You can't just drop up some blueprints and expect a facility to magically appear overnight. Goldman Sachs points out that due to severe supply chain backlogs, labor shortages, and canceled permits, only 50 to 60% of scheduled data center capacity is actually going to make it online on time over these next 2 years. So scarcity isn't just being driven by this massive demand, it is being severely compounded by real-world execution risk. And because of that massive bottleneck, geography totally dictates value right now. The coming AI boom is definitely not hitting every region evenly. You've got areas like the Mid-Atlantic, the Mid-Continent, and the Northwest that are facing elevated reliability risks. The grid there is practically choking. In fact, some of these regions are actively turning future AI data centers away. But then, on the flip side, you have these stable pipeline zones like Texas and Georgia, which have way more generation in the pipeline. If a crypto firm already happens to hold strategic land and direct grid connections in those stable zones, their valuation fundamentally transforms overnight. Location isn't just important, it's a critical part of the new digital asset equation. Which brings us to Section 2, Echoes of Bubbles, Tempering the Hike. Now, we have absolutely seen this exact pattern before. It's a classic cautionary tale. In the 19th century, we saw the massive railroad expansion boom. Fast forward to the 1990s, and it was the fiber optic network build-out during the dot-com bubble. And here we are today, in the 2020s, with the AI data center rush. It's like history rhyming, right? In all these past infrastructure booms, speculative capital just poured in. And eventually, the sheer physical capacity vastly outpaced the short-term market demand. Now, while physical assets absolutely do create long-term value, the companies that actually survive are the ones that can execute, not just the ones riding the speculative wave. We really have to temper the hype with a heavy dose of reality here. And speaking of reality, the reality of execution is brutal. A lot of crypto mining operations right now are trying to rebrand themselves as AI hubs. But guys, there is a massive difference in the hardware. A Tier 3 AI facility is highly reliable and incredibly capital-intensive. It requires ridiculously complex cooling systems and heavy, uninterrupted power. That is completely distinct from a basic, noisy, corrugated metal warehouse that was just designed to hash Bitcoin. Converting an old mining shed into a legit Tier 3 facility capable of handling advanced AI training workloads, that requires massive capital expenditure and deep, deep engineering expertise. Honestly, not every miner is going to survive this transition. As the old saying goes, history is littered with tech booms where capacity outpaced short-term demand. Consider this our impartial warning to you today. Throwing capital at any random crypto firm simply because they put out a flashy press release claiming to do AI is incredibly dangerous. You cannot just buy the buzzwords. If demand grows even a little bit slower than expected, or if these companies fail to properly convert their mining-era facilities into true AI-grade campuses, their valuations are going to outrun reality fast. You have got to verify their actual physical capabilities. Let's move to Section 3, Investor Checklist, Verifying Capabilities. So, to help you survive this new landscape, we need to throw out the old metrics and use a 4-point readiness checklist instead. First up, what are the total megawatts or gigawatts they actually control? Power is literally the lifeblood here. Second, do they have strategic land ownership? Specifically, are they in those grid-stable energy jurisdictions we talked about earlier, like Texas or Georgia? Third question, are their direct-to-grid utility contracts secured? I mean, a huge piece of land is totally worthless if you can't actually tap into the power grid. And finally, number 4, are there active multi-year hyperscaler leases in place? Like, are Tier 1 tech firms actually knocking on their door and signing real contracts? This 4-point checklist, it's what separates actual physical AI readiness from pure speculative market hype. Look, if you take away just one single thing from this explainer, please let it be this. Power matters more than tokens, and predictability is the new premium. Institutional capital will always pay a higher multiple for the long-term, ironclad predictability of a utility-style lease over wildly volatile crypto trading volumes. The companies that are best positioned for this next era aren't just the ones holding a bunch of digital assets, they are the ones holding the physical keys to AI scale. So I'm going to leave you with this final, provocative thought as you navigate this rapidly shifting landscape. In the new digital gold rush, who actually owns the power? Seriously, take a look at your own portfolios. Look past those flickering tokens on the screen and start investigating the grid itself. Thank you so much for joining me on this explainer. Keep learning, stay curious, and I'll see you on the next one.